Astronics Corporation completely crushed consensus for Q2 2026. Revenue came in at $259.96 million.
Which is what? Up 27% year over year.
Yeah, up 27%. And earnings per share hit 70 cents. It was an absolute blowout compared to the street's estimated 54 cents to 60 cents.
And they raised the full year 2026 revenue guidance too, right?
Exactly. Raised to a range of $1.02 billion to $1.04 billion. And the stock reaction was just violent. Shares skyrocketed over 12% in after hours.
Oh, yeah, and it kept surging, up over 18% in subsequent trading, hitting an all-time high of $92.78.
It's wild. So our mission for this deep dive is to look at exactly how they did this. We've got a huge stack of sources here. The Q2 earnings release, direct management commentary, some really detailed analyst notes.
Right, because we need to figure out how they engineered this blowout and, whether this momentum is actually sustainable for you, the retail investor, or if it's just a flash in the pan.
Okay, let's unpack this. We have those top-line numbers. And seeing 27% revenue growth is great. But the real catalyst behind the stock's massive surge is this explosive expansion on the bottom line.
The margins are just incredible this quarter.
Yeah, operating income hit a record $40.5 million, which is a 15.6% margin. But the craziest part is the net income. They went from a measly $1.3 million a year ago to $35.1 million.
That's just a massive leap.
It's like a manufacturing plant that finally paid off its fixed costs.
Yeah.
Every new dollar of revenue is suddenly dropping straight to the bottom line. How did they achieve this margin leverage so suddenly?
What's fascinating here is that this isn't just organic volume growth. Sure, pushing more volume through helps absorb fixed costs.
Right, like the factory analogy.
Exactly. But what we're really seeing is a result of a structural recovery program. Astronics successfully repriced 75% to 80% of its inflation-impacted long-term contracts.
Wait, up to 80%? That is a massive chunk of their business to just go back and renegotiate.
It is. For years, they were stuck in this nightmare where they were locked into these old contracts, but their input costs like labor and materials had skyrocketed.
So they were doing all the work, but just getting squeezed on the margin.
Yeah, basically bleeding out. But by going back and legally locking in these higher prices, they're finally capturing the margin they deserve for their volume.
I can't even imagine those phone calls, telling these huge aerospace buyers that they have to rip up the old contracts and pay more.
It had to be painful, right? But the proof is in the adjusted EBITDA. It hit $51.5 million for the quarter.
Which translates to a 19.8% margin, right?
Yep. Right on the doorstep of management's long-term 20% target. Everyone thought it would take years to grind back to that 20% level, and they basically did it in one quarter.
Which completely explains why the stock repriced so fast. The market was expecting a slow recovery. But to really understand this, we need to look under the hood at the two main segments, aerospace and test systems.
Right, because they're telling two very different stories right now.
Let's start with the powerhouse, the aerospace segment. This division generated $237.3 million in sales, which is up 22.6%. And the operating margin hit a really fat 20.3%.
That 20.3% margin is just the undisputed crown jewel of this report.
Oh, for sure. Especially when you consider they were at like 9.3% in the exact same quarter last year. So what's driving that?
It's heavily driven by commercial transport seat motion, in-flight entertainment and connectivity, so IFEC, and general aviation.
Basically, airlines retrofitting their older planes instead of waiting for new ones to be delivered.
Exactly. They're upgrading power systems at the seats, better Wi-Fi, all of that. And Astronics is perfectly positioned there. Plus, they're seeing the synergies from that Bueller Motor Aviation acquisition they made back in 2025.
Okay, so aerospace is doing all the heavy lifting. But let's look at the turnaround story, which is the test systems segment. I'm going to push back here because the numbers feel totally contradictory.
Go for it. It's the weirdest part of the report.
Right, because top-line sales doubled. They were up 105.1%. to $22.7 million. But then you look at operating profit, and it's a modest $600K. So if sales surged over 100%, where's the margin?
Yeah, that was the big question on the earnings call. The answer comes down to some really specific mechanical headwinds. First off, test systems is still heavily constrained by underabsorption.
Break that down for the listener. What does underabsorption mean in this context?
Think of a massive facility built to make highly technical testing equipment. The fixed costs, like property taxes, baseline engineering staff, security, they're the same whether you make 10 units or 500 units.
Right. The rent is due either way.
Exactly. So when sales are only at $22.7 million for the quarter, those fixed costs just eat up every penny of gross profit. They haven't absorbed their overhead yet, even with sales doubling.
They just need more volume. But there's also a mix issue, right?
Yeah, they shipped some inherently lower margin products this quarter, but the biggest drag is that they recognize $4.1 million of zero margin defense revenue.
Wait, zero margin. Why would a company intentionally take on $4.1 million in revenue with zero profit attached to it?
Because of how these long-term U.S. Army radio test orders work. In the early phases, you often bill the government just at cost to recover your upfront development and engineering expenses.
Ah, so it's a loss leader strategy. You do the upfront setup at cost so you can own the contract.
Exactly. Once your equipment is officially spec'd into the program, you capture all the maintenance, upgrades, and full-rate production for the next decade. That's where the real money is.
Okay, so that $600K profit looks weak today, but it's a necessary step to lock in that lucrative defense revenue later.
Yep. It's dragging down the overall company average right now, but it's a massive long-term play.
Well, speaking of the long term, we have to talk about forward visibility because markets don't care about what you did yesterday. Management confidently raised their full year 2026 guidance above $1 billion for the first time ever.
Which is a huge psychological milestone, but to do that, you need an ironclad order book. You can't just guess.
And they delivered the data. Record bookings of $306.2 million, which gives them a book-to-bill ratio of 1.18.
Right, and for anyone listening, anything over 1.0 means demand is outstripping supply. They are taking in more orders than they are shipping out.
And that pushed total backlog to a record $780.6 million. But here's where it gets really interesting. The management commentary noted that 82% of that backlog is expected to convert to revenue in the next 12 months.
That is the metric right there.
Yeah, because that 82% conversion removes the guesswork. The $1 billion target isn't some speculative hope. It's practically locked in.
They literally have the purchase orders in hand. They just have to build the stuff and ship it. This kind of visibility is why they guided Q3 revenue to $265 million to $275 million.
Which is way above the analyst estimates of like $253 million.
Way above. And it completely changes their cash flow dynamic. Management said they expect to be free cash flow positive for the rest of 2026.
Which is super important because they have a lot of CapEx coming up. They're planning $40 million to $45 million in capital expenditures, largely for consolidating their Seattle operations by Q3.
Consolidating industrial spaces is always so expensive, but because they are generating strong free cash flow, they can just absorb that cost organically.
No need to take on more expensive debt or dilute shareholders.
Exactly. And looking even further out, CEO Peter Gunderman talked about future catalysts peaking around 2027. Things like eVTOL, those electric vertical takeoff aircraft, and autonomous drones.
Basically, the flying taxis everyone has been talking about for years.
Right, but he was careful to say they won't really impact the 2026 numbers. It's more about planting seeds now for the next technological growth cycle.
Okay, so it all sounds incredibly optimistic, but the stock is at all-time highs, and the market is pricing this for perfection. As analysts, we have to look for the cracks in the armor.
We definitely do, and the biggest crack is leverage.
Yeah, let's look at the bear case. They have long-term jets sitting at $310.3 million.
Now, they have paid down about $24.1 million so far this year, which is good, but the debt-to-equity ratio is still sitting really high at 2.07.
So what does this all mean? If you're a retail investor looking at a 2.07 debt-to-equity ratio, how do you weigh that heavy debt load against these massive record margins?
Well, this raises an important question about the aerospace cycle. Debt is fine when things are booming. When airlines are spending money and you're growing, debt is just a minor fixed cost in the background.
But if the cycle turns?
Exactly. If the cycle turns and a recession hits, airlines will freeze their spending instantly. But those debt payments don't freeze. A ratio of 2.07 leaves very little room for error.
It's an amplifier. It makes the good times great and the bad times really, really ugly.
Yeah. Now, the counter-argument is that Astronics has $253.2 million in available liquidity. And since they are generating so much free cash flow right now, they are effectively out-earning their debt problem.
For now, yeah. But it's definitely the main vulnerability if the macro environment shifts. Also, we have to talk about valuation. After surging 18%, the stock isn't cheap anymore.
No, we've seen a ton of multiple expansion. Investors are basically paying a premium today for tomorrow's flawless execution.
Right. They're paying for that $1 billion guidance to happen perfectly. If management misses in Q3, or if the Seattle consolidation goes over budget, the market will punish them brutally.
Plus, there's that weird lingering uncertainty about the IEPA tariff refunds.
Oh yeah, the $6 million to $8 million in refund.
Right. It's cash The government legally owes them, but nobody knows exactly when the Treasury will actually process it. They got a small $2 million chunk, but the rest is just up in the air.
It's a small detail, but in the market price for perfection, delayed cash flows can mess up quarterly models.
Exactly.
All right, so to sum this all up, we've got a company that finally paid off its fixed costs, allowing margins to completely explode. They blew past consensus, raised guidance over $1 billion, and proved they can hit a 20% margin.
They prove the financial engine works. The backlog is massive, the legacy contracts are repriced, and the aerospace upgrade cycle is on their side.
Which leaves you, the listener, with a really provocative thought to mull over. Astronics went through all that pain to legally reprice up to 80% of their legacy contracts higher to match inflation.
Right.
But what happens if macroeconomic inflation actually cools down over the next year? If their input costs, like raw materials and energy, start to drop, but those higher contract prices are already locked in with their buyers?
Oh, wow. Yeah.
Could we see their adjusted EBITDA margins actually expand way past that 20% target? If the cost floor drops, while the revenue ceiling stays high, that manufacturing plant analogy becomes unbelievably profitable.
That is the ultimate bull case for 2027. Capturing deflationary savings on top of inflationary pricing, the earnings potential would be massive.
It's definitely something to watch closely as the macro data rolls in. Make sure you follow the show for our daily earnings coverage, where we break down the tape so you can make informed decisions about the companies in your portfolio. Catch you next time.